Hi everyone, this is Jason Burak of Wall Street for Main Street. Today is Friday, June 4th, 2010. I want to welcome everyone to my first ever weekly commodities market wrap-up. We will be talking about some of the major commodities. We'll be summarizing them and how their week went from comparing week to week. And I will be also giving my opinion on short, medium, and long-term price trends for these commodities based on technical analysis charts that I've broken down, or that my Wall Street for Main Street co-founder Mo Dawood has broken down on his blog, the Mo Money blog. And I will also be explaining some of the relationships between currencies and commodities, and we'll also be diagnosing some indicators, mostly the leading economic indicators, because those tend to involve commodities more than others. For example, a leading economic indicator like the Baltic Dry Shipping Index, where these capsized vessels, these very, very large ships, the majority of cargo that these ships move tends to be oil, iron, high-grade iron ore, copper, etc. And also the copper price is a leading economic indicator, and I believe Mo Dawood has a blog coming out with a chart breakdown of the copper price. Copper is known as Dr. Copper, and it tends to predict economic growth or economic decay. So Mo will be releasing that, I believe, over this weekend, and I'm excited to see that. But take in mind that that's just the technical analysis. As far as copper goes, let's start off with copper, since it's a leading economic indicator. The copper price is, and copper is called Dr. Copper. The copper price today hit its 5-month low, meaning that copper prices have not been lower in 5 months. If you remember, copper was a couple months ago, I believe, it was over $3.50 a pound, so it was remarkably high. And within the last 2 months, some of the copper stocks I own that I've been following have been hedging their production in at about $3.25 a pound to protect their gains. So copper looks like, to me anyways, in my humble opinion, that copper prices are starting to form a nice little bottom here. I believe there's support. I don't know what the copper chart says because I haven't looked at it recently, so we'll wait for Mo's analysis of that on the technical analysis side. But from a fundamental standpoint, copper prices, I believe, are going much higher in the long term. China needs to stockpile copper, but the dollar is strong in the short term. The dollar had a nice rally this week. The dollar index did, at least. The dollar is not really gaining against a lot of emerging market currencies, but against the G7 currencies that make up the dollar index, which is like the UK pound, the euro, the Japanese yen, etc. The dollar looks remarkably strong compared to a lot of the issues in those economies. So copper prices are down. I think it's a good time here to maybe think about starting to dip a toe into some of these copper stocks, like maybe a Freeport-McMoRan, which also has good gold exposure, or some of those, or a Southern Copper, a PCU. But that's just my opinion, guys, not investment advice. So let's talk more about the precious metals from a standpoint. You have silver, platinum, and palladium, which also have industrial components. Because copper took a hit and it's a heavy industrial usage metal and the dollar was strong, I bet you can predict the type of weeks that they've had. They had a down week. I mean, it was not super heavy down, but, you know, it's just like drudging along. A lot of these commodities really are in a trading range right now because people are trying to sort out the economic data and trying to still decide if it's inflation, deflation, etc., etc. I think most of you know my long-term opinion of this. I think we'll either long-term have hyperinflation or some sort of weird mix where we have both, where we have asset deflation and then price and monetary inflation, like what Dan Amerman says. So gold really was the only steady performer, didn't really get hammered too much this week. One of the main reasons is because this tends to be a good month for gold, because there's a lot of buying in India, so there's good demand for it. But we'll have to wait till the end of the month to see if this was a good month or not for gold buying in India. And also, gold tends to do a lot better in deflation than any other commodity. So if you have a deflation risk and you want to hedge your portfolio, the only commodity that tends to do well, because it is completely negatively correlated to almost every other asset class, stocks, bonds, real estate, etc., is physical gold. So gold would be a good deflation hedge for those of you who are worried about gold, despite what Bob Prechter says. Let's talk a little bit about oil and then the soft commodities, and that'll be it for today. As far as oil prices go, oil prices bottomed, or close to bottomed, last week. They hit the mid to high 60s. And if you've been following my other video blogs and reading some of my other articles and some of my comments that I post on the Wall Street for Main Street fan page, and I also have an article coming out about this soon about peak oil and and about clean tech energy. But what the production costs for most oil now, especially considering the Gulf spill, oil is definitely not profitable. If oil drops below $60 a barrel, especially if you're an offshore drilling rig producer, there's just so much risk and technology and human hours and a lot of other factors in insurance and a lot of other stuff involved in the production costs for a deep water offshore drilling rig that really oil is not profitable under $60 a barrel. So if oil hits $50, $55 a barrel, those offshore drilling rigs, which do make up 30% of the U.S. total oil production, are not profitable. So oil really has to stay above $65 a barrel for it to be profitable at all for those companies. And OPEC knows this. They're very smart. So if oil does drop back down, expect production cuts from OPEC. Oil, to me, at least, looks like it's in a trading range for a while. There's still a short-term supply glut, short to medium-term supply glut. I would say a lot of oil is still being stored offshore on tankers. So Goldman Sachs and some of these other guys are storing the oil offshore. There's still a short-term supply glut. Like I said, it's too much oversupply to the market, but that will be worked off as long as these OPEC member countries don't continue to increase production of oil at these prices. So we'll just have to let it play out and see. I sold some calls on one of my larger oil positions here because I think oil is getting a little toppy, and I expect it to go towards the lower end of the trading range, but you never know. We'll see. I like taking a little bit of risk. As far as the soft commodities go, guys, I mean, most of the soft commodities were down based on the stronger dollar and the dollar index, but you should definitely follow the commodities markets and the currency markets. They go hand in hand. So if you're interested in Forex and the currencies markets, you should also follow the commodities markets because they're interrelated, and you can make a lot of money off them if you understand both. So everyone have a great weekend, and I will see you next week, guys. Thanks very much for watching, and please feel free to comment on my video blog here or on Georgia's website after it's posted, and also on my blog at jasonburak.com or on the Wall Street for Main Street Facebook fan page. And have a nice weekend. Like I said, guys, I'm out.